Welcome to today's Explainer. Look, if you follow global markets at all, you've definitely seen the headlines. You've probably felt that creeping anxiety surrounding the Indian rupee's exchange rate. But today, we're going to completely strip away the panic. We're diving into the economic mystery behind the falling rupee, looking at the pure data, and honestly, we're going to reframe exactly how you look at currency.
So let's kick things off with a massive psychological anchor for most Indians. Picture this. It's 1947, independence, and 1 rupee equals exactly $1, right? For decades, this literal 1-to-1 ratio has been held up as this lost golden age of economic strength. But the actual truth? That peg was completely artificial. It was basically a colonial-era accounting legacy, definitely not a true reflection of a thriving, independent economy.
Now, contrast that 1947 figure with today's reality. $1 costs over 95 rupees. It's so easy to look at that number and just scream, currency collapse. But guys, that is entirely the wrong lens. See, as India opened up its economy and shifted to market-based rates, the true value of the currency actually emerged. And despite this depreciation, India has grown into the world's 5th largest economy, with a massive $3.7 trillion GDP. So this isn't a collapse, it's really a recalibration.
Here's our roadmap for today. We're going to cover the 79-year story, the 5 root causes driving this, recent shocks and triggers, the surprising silver lining, and finally what lies ahead. Let's get right into it.
Part 1. The 79-year story.
This timeline brilliantly illustrates that journey. We've compressed decades of monetary history here just to show you that this isn't some sudden crisis. It's a natural, long-term unwinding. Just look at the milestones. In 1966, we hit the first major devaluation of 37%. Then, 1991, a massive balance of payments crisis. Basically a severe foreign exchange shortage literally halved the rupee's value. By 93, it moved to a market float. Jump over to 2013, the infamous taper tantrum pushed the rupee from 54 to 68. And more recently, in 2025, a US tariff shock pushed it to an all-time low of 88.44. The trend here is super clear. As India integrated with global markets, the artificial scaffolding just came off.
Moving on to Part 2. The 5 root causes.
Okay, the absolute crucial point here is understanding the macroeconomic mechanics behind this. First up, inflation. India's inflation has consistently run higher than the US. Simply put, when your money buys less at home, it's going to buy less abroad too. Second, the chronic trade deficit. India imports way more than it exports. More dollars go out than come in, and that excess demand just continuously weakens the rupee. Third, when foreign portfolio investors pull their money out of Indian stocks and bonds, what are they doing? They're selling rupees and buying dollars. And fourth, high US interest rates. That attracts global capital straight to America. Emerging market currencies literally just lose out when money chases those safer, high-yield US returns. Now, take a look at that massive 70% slice right there. This is our 5th, and honestly, probably the most stubborn root cause. India imports roughly 70% of its crude oil, and yeah, it pays for it in US dollars. This structural dependency means every single time global oil prices spike, India suddenly needs a massive, massive influx of dollars just to keep the lights on and the cars running. That relentless demand puts immense, constant downward pressure on the rupee. Which brings us to Part 3, recent shocks and triggers. Tracking these recent triggers month by month makes it abundantly clear how external shocks really dictate the currency's fate. Let's look at late 2024. The rupee was kind of stable around 83 to 84, but foreign outflows started as US yields stayed high. By early 2025, it crossed 85. We did see a brief recovery in May to 84.25, but then September brought an absolute hammer blow. A US tariff shock combined with oil demand pushed the rupee to an all-time low of 88.44. 2025 ultimately wrapped up with a 4.72% decline, the worst we've seen since 2022. And as we push deep into 2026, stalled US-India trade talks and nonstop outflows sharply shoved the currency right past the 95 mark.
All right, Part 4. The silver lining. I know, all that recent data sounds pretty bleak, but it's time for a major paradigm shift. Look at this massive number, over $250 billion. That represents India's booming IT and software exports. Big players like TCS, Infosys, Wipro, they earn their revenue in US dollars, right? But they pay their massive workforces locally in rupees. So when the rupee weakens against the dollar, what actually happens? It basically creates fatter profit margins for these huge tech firms, and they don't even have to lift a finger. Similarly, check out this staggering figure, $125 billion a year. This is NRI remittances.
Non-resident Indians send back way more money to their home country than any other diaspora in the entire world. So, when the exchange rate drops, it means every time an NRI sends, say, $1,000 home, their family in India gets significantly more rupees. This instantly boosts local purchasing power and injects massive liquidity right back into the domestic economy.
Furthermore, it makes physical goods incredibly competitive on the global stage. A cheaper rupee means Indian textiles, pharmaceuticals, and engineering products suddenly look vastly more appealing to international buyers. And look, if you're sitting there worried about a total economic crash, don't be. The Reserve Bank of India is sitting on a colossal $640 to $700 billion forex reserve. They use this massive war chest to intervene in the markets, smoothing out the volatility. They essentially ensure that this decline remains a gradual, orderly adjustment, rather than some chaotic freefall.
This brings us to Part 5, What Lies Ahead. When we actually compare the expert forecasts side by side, we get a really fascinating spread. Bank of America predicts a correction back down to 86 by the end of 2026. They explicitly note that the recent fall was driven by global factors, not any fundamental weakness in India's economy. ING Bank is forecasting 87, expecting things to strengthen based on a potential long-awaited US-India trade deal. On the more cautious side, though, Wallet Investor sees the rupee staying at 90+ in 2026, warning it could weaken even further if that trade breakthrough just doesn't happen. The clear consensus here: the currency's immediate future relies heavily on global factors and trade dynamics, way more than any domestic failures.
So the ultimate takeaway here is this. The rupee's 79-year decline is very, very real, but it heavily reflects the structural reality of a rapidly growing $3.7 trillion market economy that's becoming deeply integrated into global trade. India is experiencing higher growth and navigating higher inflation, all while facing the undeniable structural weight of US dollar dominance and that inherent stubborn dependency on imported oil.
Which brings us to the final, absolutely crucial question you should be asking to resolve any of that lingering economic anxiety from the headlines. Is this fall orderly and manageable?
And the definitive verdict from the data is a solid, stabilizing yes. It is a manageable unwinding, not a freefall. But as we've seen today, currency is inextricably linked to global geopolitics. So the big question I'm going to leave you with is this. As India's economy continues to explode globally, will its booming exports ultimately flip the script on dollar dominance? Or is a weaker rupee just the permanent cost of rapid growth? Keep an eye on those trade talks to find out. Thanks for joining me on today's Explainer, and I'll see you next time.